In this video, I'm going to show and go over the tax forms that a self-employed person uses to file their taxes. This would be people who just begin working for themselves. They didn't form any business entity with the state. Usually when two people work together, they're a partnership, but there is an exception for married partners as long as they didn't form any entity. Independent contractors receive pay without having taxes withheld, and at the end of the year, they'll receive a Form 1099 Miss stating the amount they received. A single-member LLC is an entity formed with the state, but it's an LLC with only one member, and they will file their taxes the same as a self-employed person as well. So let's get started. People who file as a self-employed person are called sole proprietors. For tax, they do not have to file a separate tax return for their business, like they would if they were a partnership, multi-member LLC, or a corporation. Instead, a Schedule C reports the business income and expenses, and the net income or loss flows to their individual tax return. The Schedule C is attached to the Form 1040. Losses offset all of the types of income as long as the owner materially participates in the business and is at risk for losing the investment should the business fail. The business income, with any other income the owner has, is taxed at the owner's income tax rate on their individual tax return, the Form 1040. The individual owner also receives a deduction for 1/2 of the self-employment taxes paid. Self-employment taxes are Social Security of 12.4% and Medicare of 2.9%, which are calculated based on 92.35% of the business net income from the Schedule C. This calculation is done on Schedule SE, which is attached to the Schedule C and submitted with the owner's individual Form 1040. Now let's take a look at the forms. This is the Schedule C, which reports the sole proprietor's business income and expenses. The first section is general information, the owner's name, social security number, principal business or profession, which is just what they are in the business of doing. So for my business, I would simply put education. The Schedule C instructions have various codes related to the type of business to enter in box B. Note that this is just for statistical purposes, and it is perfectly fine to pick a code that is close to your business description. It does not have to be exactly what your business does. Also, you can use the miscellaneous number 999999 if you do not see a code that fits your business. If you filed a DBA doing business as with your state or created a single member LLC with your state, you may have a business name to enter on line C. You also may have an EIN, Employer Identification Number, to enter on line D. You are required to have an EIN if you have employees, but you can also get an EIN to use in your business instead of your Social Security number. Often people simply prefer to keep their Social Security number private and use an EIN on other business documents. The accounting method will usually be cash basis for sole proprietors, which simply means you report your income when you receive it and your expenses when you pay them. You should be aware if your business uses the accrual method, which reports income as earned and expenses as incurred. Very different and more complicated than cash basis. The next question asks if you, the owner, materially participated in the business. There is detailed qualifying criteria to determine this, but in general it is asking if you worked in the business. Most sole proprietors work full-time in their business and would answer yes, that they materially participate. If you do not materially participate, you may not be able to deduct losses from other income. For line I, if you paid anyone other than a corporation more than $600 in pay or for anything, you are required to file a Form 1099 Miss for them at the end of the year to be able to deduct the expenses on your Schedule C. These questions ask if you need to file these forms and if you have or will file these forms. The income section is fairly straightforward. You report your total sales and returns refunds to get you to your gross income on line 7. If you have inventory and sales of over 1 million, you may need to report cost of goods sold. Even if you have less income than the 1 million threshold, you may still want to use cost of goods sold so you have the information. Cost of goods sold come from line 42 on page 2, and we will look at that in a moment. The expense section is next. Tax-deductible expenses include all ordinary and necessary expenses for your business and industry. Things like advertising, vehicle expenses, which come from page 2 and we will cover in a moment, commissions, fees paid, contract labor, insurance, interest expense, professional services like tax preparation, lawyers, office expenses, pensions, rent, repairs, supplies, taxes and licenses, meals and entertainment. Now, this is one people often ask about. Note that it is perfectly acceptable to have these costs, but be sure to have detailed documentation of the business nature of the meals and/or entertainment. Also note that only 50% of total meals and entertainment are deductible for tax purposes. For any assets you have, you'll take depreciation expense. At the bottom of the form, total income minus total expenses gives tentative profit on line 29. If you have a home office, the deduction is calculated on form 8829, or you can use the simplified method right on this form and the deduction is reported on line 30. Net profit or loss is then reported on line 31. The final questions at the bottom ask if you are at risk of losing your investment. If you are the only owner that has invested money and assets in the business, then you would answer all of your investment is at risk. On page 2, this is the calculation of cost of goods sold for line 4 on page 1. In general, people use cost to value their inventory, what they paid. This calculation begins with your beginning inventory value amount for the year, and then adds the cost of all purchases of inventory throughout the year. Then, other costs closely related to the inventory can be kept track of as inventory, and therefore are not deducted as expenses until the related inventory items are sold. Such costs can include labor, materials, supplies, and any other costs that may be relevant for your business. These costs are totaled, and then the inventory value at the end of the year is subtracted, and the difference is the cost of goods sold for the year. Part 4 reports your vehicle information. For the simple vehicle deduction, business miles times the standard mileage rate of 56.5 cents for 2013 equals your vehicle expense deduction in Part 2. Taxpayers are also asked if they have written documentation for these miles, as a vehicle logbook with detailed mileage documentation is required in the event of an audit to substantiate the vehicle deduction. The last section allows owners to report descriptions of expenses reported under other expenses in Part 2. Keep in mind that tax rules are not intuitive, nothing about them. So when you try to apply the information in this video to your situation, you will have questions because there are a lot more rules. So ask questions and be sure to find the answers for your situation.